Right now, Rani Therapeutics Holdings, ticker RANI, is trading at $1.64, which is up a staggering $1.17, or 248.27% on the day. And let's be perfectly clear, this is not a technical bounce. This is not a short squeeze. This is a fundamental ground-up repricing of a company that, frankly, the market had left for dead. Just look at the volume. The average volume for Rani is typically a few 100,000 shares. Today, we have seen nearly 500 million shares change hands. The entire float and then some has been traded. This is the kind of move that burns short sellers to the ground and mints new accounts overnight. The kind of spike that lights up every Robinhood stock trading feed and SoFi Invest dashboard. The expectation for this stock as recently as last week was essentially zero. It was a sub-50-cent cash burn Biotech, a speculative name you'd throw $100 at using Robinhood fractional shares and pray. The reality today is that Rani just bought itself years of life and secured validation from a major global player. But here is the immediate insight, the part that separates the headline chasers from the serious analysts. Everyone is looking at the headline that mentions a potential $1 billion deal with Chugai Pharmaceutical. That's the expectation. The reality is far more nuanced and, in the short term, arguably more important. This event was a 1-2 punch. The first was the Chugai collaboration, which is a massive win. But the second, announced concurrently, was a $60.3 million private placement, a PIPE. The Chugai deal provides the validation. The PIPE provides the actual immediate cash. And here's the kicker. That private placement, led by heavy-hitting biotech investors like Samsara Biocapital and RA Capital, was priced at $0.48 per share. Think about that. Major institutions just agreed to inject $60 million at 48 cents. This is the anchor. This is the new structural floor that the market is using as a launch pad. The retail crowd piling in today on their Fidelity mobile app or Interactive Brokers platform are paying $1.64, more than triple what the smart institutional desks paid for their investment. So, what just happened? Let's break down the expectation versus the reality. The common belief about Rani was that it was on a death watch. It had a fascinating piece of technology, but it was bleeding cash as almost all clinical stage biotechs do. Its balance sheet was deteriorating, and the market was signaling a high probability of bankruptcy or a painful reverse split just to stay listed. You wouldn't put this in your Fidelity IRAs or a managed intelligent portfolio. This was a gamble, not an investment. The expectation was that the technology, however clever, would never see the light of day because the company would run out of operating funds. The reality that hit the market today completely shattered that narrative. First, the Chugai deal. This isn't just a small research pact. Chugai is paying $10 million up front. They are on the hook for up to $75 million in development milestones and $100 million in sales milestones, plus royalties, for one single drug target. The real headline grabber is that Chugai has the option to extend this agreement to 5 more targets under similar terms. You do the math. That's how you get to the $1.085 billion potential figure. This is transformative. It's a major Japanese pharmaceutical company looking at Rani's technology and saying, "We believe this works, and we are willing to pay for it." This is the kind of validation that money can't buy, although in this case it came with a $10 million check. This immediately changes the conversation from if to when. Second, the $60.3 million PIPE. This is the lifeline. This is the fuel. Combined with the upfront payment, Rani has just stated that its cash runway, the amount of time it can operate before needing more funds, is extended into 2028. This is an eternity in the biotech world. It takes the immediate suffocating financial risk right off the table. This is what the market is truly reacting to. The bankruptcy clock has been reset. The company now has the capital to execute its plan, to advance its own pipeline, and to support the Chugai collaboration. This is no longer a company worried about keeping the lights on. It's a company focused on hitting milestones. It's a profound shift in sentiment. This single move provides the kind of investment help that no analyst report could. But let's talk about the cost of this survival, the other side of the reality coin that the current euphoric price spike is ignoring. That $60.3 million financing at $0.48 was massively dilutive. The agreement includes the issuance of 42.6 million shares and pre-funded warrants to purchase another 82 million shares. And on top of that, there are accompanying warrants to purchase another 125 million shares at an exercise price of $0.48. This is a colossal amount of new paper. The share count is going to explode. While this dilution is what saved the company, it creates a massive overhang. Every single one of those warrants represents a future seller at $0.48, who is already up more than 200%. This is the catch. The traders buying today at $164 must now absorb all that future supply. This is a far cry from buying a blue chip like Apple stock or a behemoth like Nvidia stock on the Fidelity trading platform. This is a different sport entirely. So, what does Rani Therapeutics actually do? The expectation is that it's just another biotech. The reality is that it's a drug delivery company. This is the core of their value. Many of the most effective modern medicines, biologics, antibodies, peptides, cannot be taken as a pill. They are proteins that the stomach would simply destroy. That's why they must be injected. Think of insulin or the new blockbuster obesity drugs. Rani's core technology is the RANI pill. It's a robotic pill. You swallow it, it passes safely through the stomach, and once it reaches the intestine, it inflates a small balloon that presses tiny dissolvable needles made of the drug itself into the intestinal wall, which has no pain receptors. The drug is absorbed directly into the bloodstream, bypassing the digestive system. It's a way to turn injections into pills. This is the platform that Chugai is licensing for its rare disease antibody. This is why the deal is so significant. It's not just about one drug, it's a validation of the platform. If it works for Chugai's antibody, it could work for hundreds of other biologic drugs. This is the multi-billion-dollar carrot. The company has its own pipeline, including an oral version of teriparatide RT102 for osteoporosis, which has already completed a phase 1 study. They are also working on an oral version of adalimumab, the active ingredient in the blockbuster drug Humira. The potential here is without question enormous. This is the kind of high-growth, high-risk online investment that many people using investing sites dream of finding before the rest of the market. Now, let's look at the future outlook, framed by our new set of expectations and realities. The new immediate expectation for many retail traders, especially those using SoFi Investing or Robinhood app, is that this stock is just going to keep running. They see the $1.64 price, they see the analyst targets from before this news that were at $7 or $10, and they think this is an easy multi-bagger from here. They see it as the next Tesla stock in its early days. The new reality is much more complicated. The company is now funded. That's the bull case. It's de-risked financially. The bear case is that it is now a science story, and science is hard. The Chugai partnership has to actually work. The clinical trials have to succeed. Any failure in the lab will be punished severely. And more importantly, the technical reality is that you have 125 million warrants sitting at 0.48. This will likely create immense selling pressure, acting as a ceiling on the stock price for some time. Every time the price tries to run, warrant holders can sell their shares for a quick 200-300% gain, flooding the market with supply. This is a classic biotech scenario. The company is saved, but the existing shareholders have been diluted into a much smaller piece of a much larger and now more valuable. This is not a stock you just buy and forget about in a Fidelity wealth management account. This is a name you have to actively watch. It requires a sophisticated platform like Interactive Brokers to manage the volatility, not just a simple self-investing app. Here's a question for everyone watching. Comment below with your thoughts on the dilution. Do you think the 0.48 warrants will cap this rally and keep the stock pinned under $2? Or is the Chugai validation so strong that the market will absorb all that supply and move higher? This is a classic setup for online investing. You have a story stock, a massive catalyst, huge volume, and a clear conflict between